Hello everybody and welcome to this Sustainalytics webinar on our new report entitled 10 for 2015 Generating Value in a Fragile Market. My name is Niamh O'Sullivan. I am an Associate Analyst in Sustainalytics Thematics Research Team and I have the pleasure of being your moderator for today's webinar. I am delighted that so many of you could join us here on the webinar today. At last count we had 140 participants and I would like to extend a special note of welcome to those of you that are joining us for the first time. If you are unfamiliar with Sustainalytics and who we are and what we do, we are an international responsible investment research firm providing detailed analysis and company ratings on environmental, social and governance issues, otherwise known as ESG issues, for institutional investors so that they can use this information in their investment decision-making processes. One of the many things that Sustainalytics does is produce periodic reports on key environmental, social and governance issue materiality for a wide range of industries and companies across our research universe. And in the last 2 years, what we have done in parallel to this is produce reports at the start of the year to act as an outlook on ESG risks and opportunities associated with who we believe to be the top 10 companies to watch for those particular years. So in this case, 2015. And we believe that these views that we present in the reports can be highly beneficial for investors to take into consideration in their asset allocation and selection processes. And that's essentially the basis of the 10 for 2015 report. So, as I was just explaining, that's the basis of the 10 for 2015 report, which we will be presenting to you in more detail in a moment. I am joined here in our Amsterdam office by Dr. Hendrik Garz, who is Managing Director of Sustainalytics Thematic Research Team. And we are also joined in our Toronto office by Mr. Doug Morrow, who is an Associate Director in Sustainalytics Thematic Research Team. Doug and Hendrik have co-authored this report in association with our research product analyst colleagues across Sustainalytics offices internationally. And in a moment, Doug and Hendrik will be presenting the main structure, key findings and takeaways of the 10 for 2015 report to you. This presentation will take approximately 35 to 40 minutes and will be followed directly by a Q&A session of 15 to 20 minutes. So we will wrap up at 5 p.m. Central European Time. Before we begin, I would like to introduce you to some housekeeping issues. You are all muted currently on the webinar due to the large number of participants, and you will remain to be muted throughout the course of the presentation to try to avoid any background noise and interference. In this instance, we would like you to send through any questions you have on the report or the presentation through the interactive box you can see here highlighted on your screen. We would like you to send through the questions in the box highlighted in number 1 throughout the presentation so that we can use them to lead the Q&A directly after the presentation. Incidentally, if you have any technical problems or queries you would like to raise, you can also highlight those to us through this box and we will try to address them as soon as possible. Also, if you would like to minimize this interactive box from your screen, you can quite simply click on the arrow here indicated through number 2 and you will be able to see the presentation more clearly. Finally, this webinar is being recorded at the moment and it will be sent to all participants in the next few days. So without further ado, I would like to pass over to my colleague Hendrik, who is going to begin the presentation.
Many thanks, Niamh, and a warm welcome to the presentation of our 10 for 2015 report also from my side. First of all, let's have a quick look at today's agenda. I will start with a brief introduction and will then take a look at the first main part of our report, the macro section. Before I will hand over to my colleague Doug to cover the micro section of the report. We will close with a Q&A session covering both main parts of the report. Our report offers an integrated view of the economy, the markets and companies from an ESG perspective. It also comprises a foreword of our CEO, Michael Jancy, offering his view of and an outlook for the RI market in 2015. It is the second report in an annual report series, and we plan to publish sequels in January of each year. Coming to the objective and philosophy of the report. Generally speaking, we aim to add value to the investment decision-making itself by taking ESG perspectives into account. So it's not about best-in-class or other structured approaches, it's about true ESG integration. This implies that the focus deliberately is on financial materiality. Please note, however, that we do not claim to provide a full-fledged economic and financial analysis with this report. Rather than that, we strive for an enhancement of traditional analytical frameworks. Another characteristic of the report is that we provide forward-looking views without explicitly delivering forecasts. In particular, we are not providing buy or sell recommendations. We frequently work with scenario-based approaches, which you may interpret as taking a risk perspective, with the term risk interpreted to include a downside as well as an upside component. We also strive to provide clear opinions, sometimes deliberately contrary. This is related to our conviction that investment research can only add value if views are expressed that deviate from the consensus opinion, which in turn is reflected in market prices already. The report has two main sections organized in a top-down manner, resembling the usual structure of most investment processes. We start with the macro section, which analyzes recent macroeconomic and financial market trends from a dedicated sustainability perspective. We focus on two main issues. Number one, excessive liquidity and bubbles on financial markets. And partly related to that, number two, the implications of the slump in oil prices. We do also provide a separate dedicated Asian view, reflecting our special expertise, coverage and presence in this region. In this part we are focusing on the big three, China, India and Japan. The main addressee of the macro section of the report is the investment strategist. The content we provide is supposed to inform the strategist's market timing decisions and the asset allocation process, i.e. it is designed for helping to pick regions, asset classes and sectors. We then move over to the micro section of the report, which has portfolio managers and buy-side analysts as its main addressees. In this section we aim at supporting investors in identifying ideas that potentially generate risk-adjusted excess returns, better known as alpha. We provide 10 individual, largely uncorrelated company stories that still have three common denominators. Firstly, they are all driven by ESG factors, commonly neglected or underweighted by financial markets. Secondly, these factors are all evaluated to be financially material. And thirdly, all stories have a catalyst in 2015, i.e. should be closely monitored by investors in the coming months. To clarify once again, we do not provide a thematic stock picking exercise here, i.e. we do not look at groups of companies that are exposed to a common theme. We do that in other publications, but may also consider to add such a component to our 10 for 2016 report. Now coming to the macro section. Okay, thanks. As said already, we address two main themes, which are partly intertwined. Firstly, the systemic risks of excessive liquidity, and secondly, the implications of the oil price drop from a market and an ESG perspective. On this page, we start by taking a look at the abundant, we would even say excessive, but that's of course judgmental, supply of liquidity driven by monetary policies around the globe. In particular, we refer to the Fed, the Bank of England, the Bank of Japan, and now more recently also to the European Central Bank, the ECB. As you know, the ECB is in a quite spectacular, although not unexpected move, announced a 1.1 trillion euro quantitative easing program spanning the period from March 2015 to September 2016. As shown in the upper graph on the left-hand side, this move would elevate the bank's balance sheet volume to a level that is similar to the one the Fed is exhibiting today. From our point of view, the aggressive monetary policies have pushed financial markets into an historically exceptional situation, bringing them closer and closer to a tipping point. They, i.e. the markets, currently appear to us like a black hole absorbing all of the abundant liquidity that is supplied, rather than the real economy as originally intended by monetary policy makers. This has led to valuation levels that we consider to be unsustainable over the mid to long term. In other words, we expect rates and valuations to revert to their means. And the burning question for investors, of course, when and how this will happen. Since by definition the burst of a bubble is unpredictable, or at least the timing of it is, and I refer you here to Alan Greenspan's famous irrational exuberance speech of 1996 in which he addressed the so-called dot-com bubble. So once again, since the burst of a bubble is unpredictable, we decided to not try to do the impossible but focus on the second burning question, i.e. the how. So to briefly reiterate, the question is, how will markets revert to the mean? Will it be a soft landing or a hard landing? Since we are not aware of any historical examples where extreme valuation bubbles deflated smoothly, we will consider the likelihood of a hard landing of markets and linked to that the risk of systemic failure as much higher. Oh, sorry. Okay. So when we talk about historically exceptional valuation situations, we do primarily refer to the fixed income markets as shown in the graph on the left-hand side, with yields in some cases even dropping below zero. The third burning question for investors hence is, what are the possible catalysts for a burst of the bubble? What are the things I have to watch out for? In most cases, bubbles burst following external shocks to the system. And currently, there is certainly no lack of candidates. For example, geopolitical developments, e.g. the Ukraine conflict, a breakup of the Eurozone triggered by an exit of Greece, for example, or, less obviously so, an unexpectedly significant adjustment of monetary policies in response to an upward growth surprise, a scenario to which I will come back later in the context of the oil price drop discussion. Assuming for a moment that a hard landing indeed materializes, what would be the consequences? First of all, due to the significance of sovereign and corporate bond holdings in many institutional portfolios, a massive revaluation of bond markets bears the risk of a new financial crisis with spillover effects to the real economy, including corporate failures, increasing unemployment and wealth losses, all potentially leading to social unrest and turmoil. What are the implications for investors? First of all, our tactical view. We believe that over the short term, investors can hope for further postponement of massive revaluations due to the comfort provided by the liquidity glut we have talked about. The safe haven over the short term seem to be high-quality sovereign and corporate bonds as well as equities. Banks, in particular European banks, should be avoided from a sequential risk perspective. They would be the first that suffer from a market collapse. And turning to the long-term view, the inconvenient truth is that there are not many opportunities available for investors to hedge against the systemic risk we have described. Even cash might not be a viable good idea, since the abundant liquidity we have described may finally be converted into consumer price inflation. Now we come to the second main topic of the macro section, the implications of the slump in oil prices. As you can see in the graph on the left-hand side, the oil price has more than halved over a period of just 6 months since mid-2014. Over the past 30 years, this period belongs to the handful of examples, 6 including the current one to be precise, where prices declined by 30% or more within a 6 months time frame. All of these episodes were related to major global events. The spectacular drop of oil prices observed in 2008, for instance, overlapped with the financial crisis of this period. The size of economic stimulus is truly immense, i.e. the oil price drop is equivalent to a fiscal stimulus package of an estimated $2 trillion US, similar to what was spent as a reaction to the global financial crisis of 2007-2008 by the G20 countries, just to put this amount into perspective. As a consequence of this, we have the feeling that the consensus growth forecast for 2015 may be too conservative. The IMF, for example, has even reduced its forecast in January from 3.8 to 3.5%. The forecast of the World Bank stands at just 3%, which is quite low from an historical perspective. Hence, what we did in the report is to look at a contrarian scenario in which the collapse in oil prices creates a significant upward surprise in GDP growth, which in turn triggers an unexpectedly rapid tightening of monetary policies. And this brings us back to the previous discussion about a hard landing of financial markets, for which we identified a positive GDP growth surprise as a possible catalyst. The possible consequences have already been described before, i.e. a massive revaluation on financial markets, in particular on bond markets, and a new financial crisis with spillovers to the real economy and possibly high social costs. Last but not least, we are looking at the implications of the oil price drop from a decarbonisation perspective. In particular, we come to the conclusion that the oil price drop firstly reduces the economic incentives to switch to renewables and, more generically speaking, to innovate. Secondly, it hurts unconventional oil producers, in particular shale oil producers and their suppliers. As shown in the graph on the left-hand side, shale oil production has increased massively over the last couple of years, driven by the fact that high oil prices enabled investors to achieve decent returns despite high production costs for shale oil. Now, with the oil price drop, investors are confronted with tangible stranded asset risks much more quickly than expected. Thirdly, and this is good news, the oil price drop provides an opportunity to remove fossil fuel subsidies at low political costs. The most prominent example here is India. And finally, it unfortunately adds pessimism with regard to the outcome of multilateral climate negotiations. A failure of the COP21 conference in Paris at the end of the year, from our point of view, is likely to catalyze a fundamental shift in attitudes and approaches of economic actors. We expect the new focus to be firstly on adaptation rather than mitigation, secondly on regional solutions, and thirdly on private investments with sufficient short-term financial returns. With this rather mixed and risk-focused outlook from the macro level, I will hand over to my colleague Doug for the micro section of the report, which contains a couple of very positive stories as well, to make sure that you don't leave us with a too depressive mood at the end of the webinar. Doug?
Thank you, Hendrik. And as mentioned, our intention in the micro section of the report is to move from an asset allocation focus to an asset selection focus by really looking at 10 companies where ESG factors can be shown to be driving potentially material financial impacts. Of course, the stories are not the only ones in our research universe of 4,500 companies that can be used to illustrate the financial relevance of ESG issues. We selected them because, generally speaking, we felt they were mainstream, highly topical business stories that also have a clear but sometimes overlooked ESG dimension. And just to reiterate what Hendrik said, our analysis is really, it's not meant to be a substitute for complete security evaluation. We like to think of our work as part of an enhanced due diligence process that portfolio managers could integrate at the margin of their existing security selection processes. The stories themselves are fairly well diversified. They cover 10 separate industries, 8 countries, and they have a generally good mix of ESG themes and issues. And in the end, we had 5 positive stories and 5 negative stories. So you can see here an overview of the 10 companies that I'll be talking about shortly. And just by way of introduction, what I'd like to do with each story is offer a 1 to 2 minute summary of the key issues and then the summary of our analysis. And then I invite attendees to submit any questions they might have through the webinar interface, and I'll be happy to address them at the end of the presentation. So our first story looks at DuPont, and specifically the company's 2013 acquisition of Pemex Seed through its agricultural subsidiary DuPont Pioneer. And in this story, we take a contrarian view. We argue that the deal may, in fact, expose shareholders to a long-term downside risk. The acquisition obviously boosted DuPont's presence in the African seed market. You can see here on the map graphic, we estimate it increased the company's distribution channels on the continent from 8 to 15 countries. Fundamentally, we're concerned that DuPont's business model, which focuses on hybrid and genetically modified seeds that need to be repurchased annually, may be at odds with the needs of the smallholder farm market. These farmers tend to be economically marginalized and have historically planted open pollinating crops. DuPont, of course, is aware of this challenge, and they've experimented and are experimenting with a variety of innovative pricing models, but we expect that at least a portion of the market will be reluctant to switch to hybrid seeds, even in the face of an ostensible yield benefit. We also are concerned that DuPont's focus on hybrid seeds could attract unwanted reputational challenges similar to those that have hit Monsanto in recent years. As you can see in the bottom graphic on the slide, DuPont is ahead of the industry curve in the sense that it has developed a policy on genetic engineering, something that most companies in the chemicals industry have not done. Our analysis suggests that the policy does trail industry best practice in some areas. So time will tell how the company's strategy pays off in the African seed markets, but looking ahead, we would not be surprised if revenue capture proceeds at a slower than expected basis. And considering, based on 2013 data, 32% of DuPont's top line revenue came from its agricultural business segment. So any slowdown or difficulty in cracking the smallholder farm market could potentially have significant financial implications for shareholders. So our second story explores Intel's plan to build a conflict-free supply chain by 2016, and obviously we and others believe that this goal, executing this goal, will be challenging. We're fundamentally bullish on the company's efforts and strategy. It's interesting. I noticed recently on Intel's dividend declaration last month that the About Intel section now makes specific mention about their efforts around conflict-free microprocessors. So it's obvious this issue has grown to transcend the company's branding and corporate communications. So the crux of this story is that Intel is really distinguished from its peers by a long-standing interest in conflict minerals, which, as most of you probably know, this refers to minerals, primarily tantalum, tungsten, tin, and gold, that are produced by mines located in conflict zones in the Democratic Republic of Congo. So as shown in the top graphic on this slide, you can see Intel was the first semiconductor company globally to set up an internal conflict minerals team, and as shown in the graphic in the bottom, using one of our in-house indicators, it remains one of the few companies today in the industry with a really broad, well-defined policy to manage risks around conflict minerals. So what this means operationally is the company has really built a comprehensive bottom-up system to trace the use of conflict minerals across its entire supply chain, and that's where the company is heading in any event. we're obviously skeptical that Intel's customers would necessarily be willing to pay more for conflict-free products, but we think our analysis is that the company's pioneering efforts on this issue could offer carryover reputational benefits, and of course, if and when there ever were a shift in consumer preferences for so-called ethical electronics, obviously Intel would be well positioned to capitalize on that trend. And I guess thirdly, we also think that the IP and the procedures that Intel has invested in over the last couple of years could also reduce potential transaction costs in complying with future traceability regimes, such as the one the EU is considering. So our third story looked at GlaxoSmithKline and the effect that recent changes to the company's remuneration strategy might have in terms of rebuilding regulator trust following the approximately $500 million US fine that the company incurred in China back in September for bribing doctors and other medical professionals to promote GSK products in the Chinese market. We took a positive angle in the story because we felt that less well documented in mainstream financial media were substantive changes to GSK's sales and marketing practices that had been announced by management back in the summer of 2014. So under the new scheme, which is in effect in the US and we expect to be rolled out globally, although we are waiting for more disclosure on this front from management, pharmaceutical sales reps are compensated based on their contribution to general business performance and on their knowledge of improving patient care. So again, we're obviously waiting on details about what this looks like in practice, but it's clearly a departure from the mainstream model where sales reps are compensated based on prescription targets. And we expect some bumps along the way, and the policy changes, frankly, may even put short-term pressure on GSK's revenues. But ultimately, we see the industry moving in this direction towards these sorts of remuneration schemes, so we think GSK will find itself ahead of the curve. And just to explain that graphic on the left-hand slide, this showcases our work into remediation time for companies that are caught up in severe bribery and corruption cases. And what it shows is that companies like GSK that exhibit proactive and really well-managed policy responses to these sorts of controversies can clear the incident, so to speak, within 12 to 18 months of the event's onset. So what that means is we expect GSK could clear this controversy by mid-2016. So our fourth story concerns the potential merger of Lafarge and Holcim, the world's two largest cement manufacturers. This would clearly be one of the standout M&A transactions of 2015, should it materialize, which seems increasingly likely. And we took a positive view of this merger from an ESG standpoint. We looked at a whole variety of issues. We looked at governance practices. And when it's announced, we expect that the combined board of the new entity will be able to draw upon the strengths of each company. So Lafarge's board, for instance, benefits from superior gender and national diversity, as well as really good industry experience. And Holcim's board tends to be more independent and offers a really attractive mix of skill sets. So we're optimistic that the combined board, when it's announced, will be able to draw upon the unique strengths of each founding company. Generally speaking, we find the policies, the overall ESG stance and policy framework to be complementary, which bodes well, we think, for short-term integration. And then from an environmental standpoint, if you look at the list of assets that each company has to divest of in order to get regulatory compliance for the deal, it's clear that Lafarge Holcim will have a change in risk exposure to the ETS, the emissions trading scheme in Europe, and it's too early to say, of course, what that will look like in terms of the company's P&L statement, but our analysis suggests that upwards of 8 million tons, the company will have 8 million fewer tons of carbon potentially covered by the ETS. And then lastly, looking at each company's historic focus on the market for sustainable building materials, we're pretty bullish that the combined entity will be able to disproportionately benefit in terms of capturing a growing share. Both companies are, as I said, active in the space. For example, Lafarge's Thermidia and Hydromedia concrete line. And with an estimated R&D budget of $240 million, we expect more and more innovation on that front. Thank you. Our fifth story, this was a relatively straightforward piece on Lonmin and the company's exposure to the findings of the Marikana Commission, which are expected in March. Of course, the so-called Marikana massacre, which occurred back in August of 2012, where 34 mine workers on strike at a Lonmin property were killed, it remains very much a board-level concern at Lonmin. And it's interesting, even at the company's AGM in London last month, the CEO, Ben Magera, reportedly spent a significant amount of time talking about this issue. So it really is a top-of-mind focus still for management. In any case, in our piece, we took a negative view, we took a negative stance, solely because we and others, we expect Lonmin is unlikely to emerge unscathed in the Commission's final report. We certainly do not want to speculate on how the Commission will assign blame or its specific recommendations, but based on the severity of the recommendations, we think the impacts could range from reputational challenges to potentially even a short-term reactionary downward pressure on share prices, and even looking out further, potential difficulties in the company's ability to attract top talent in executive management. Some people have talked about the possibility that the Commission's findings will inflame union tensions. We think the risk of industrial action is low, solely because Lonmin and the company's majority union, the AMCU, are fresh, relatively fresh from signing a new agreement following that 5-month strike, the recent strike where employees lost upwards of $1 billion in earnings and the company lost $2 billion in revenue. So we think the risk of actual industrial action is low. So as the share price graph shows, obviously Lonmin shares have been under pressure, largely on the back of labor problems and weak platinum prices. But we think that part of this is also priced in potential negative effects from the Marikana Commission's report in March. So in our sixth story, we looked at National Commercial Bank, which is the largest bank in Saudi Arabia by assets, and it recently went public with a $6 billion IPO back in November, which was the second largest IPO of the year, trailing only Alibaba. So what makes NCB noteworthy for investors are really two things. One, it's one of the few banks in the country and the region with a explicit focus on Islamic banking. So the NCB is on track to become a fully Islamic bank over the next 5 years. And as shown in the slide, the graph top of your slide there, data from Ernst & Young and others show that the market for Islamic finance is really exploding. It's growing very rapidly. This graph shows the assets in Shariah-compliant products and services in just 6 countries, at commercial banks in just 6 countries, and the market is expected to top 1.6 trillion by 2018, so it's obviously an attractive market. And then dovetailing with this, of course, is the potentially landmark issue in 2015 where Saudi Arabia is expected to open its equity markets to foreign investors. This means, of course, the NCB could be targeted by Western investors, institutional investors, as a way to gain exposure to the Islamic finance market. So again, while the fundamentals of the market are obviously attractive, we actually took a negative stance on NCB from an ESG standpoint. One concern we have is simply about ownership. So even after the IPO, NCB is still nearly 65% owned by various organs of the Saudi Arabian government, which could interfere in NCB's decision-making and independence. And our story also points to other changes ranging from accusations of terrorism financing to business ethics concerns and potential risks in lending activities, as the bank has not signed up to the Equator Principles, although it does claim to integrate ESG concerns in its project finance activities. So overall, to summarize, we think that investor enthusiasm for NCB should be moderated by the company's exposure to ESG risk. In our seventh story, we reviewed Telenor's recent entry into Myanmar. So the context here is that following the end of military rule in 2011, Myanmar invited foreign telecom companies to help develop the country's mobile phone infrastructure. The opportunity here is really enormous. As some of you might know, Myanmar has a population of 53 million, but has extremely low internet and mobile penetration. So as shown in the graphs on the slide, you can see the internet penetration rather of Myanmar is 11%, and internet penetration is 1%. So we're really talking about very significant growth opportunity. But on the other side of the equation, the risks of actually doing business and conducting operations in Myanmar are myriad and largely stem from the country's 50-year history of military rule and human rights violations. So it's a challenging environment. And then, of course, from a telecom standpoint, there's related issues and risks related to data privacy, the risk of government-sponsored network shutdowns, and surveillance activities. Despite these risks, we actually took a positive stance on Telenor's approach. We were encouraged by the extensive due diligence the company's done from a human rights standpoint. It has very good human rights policies. It's engaged with NGOs. It did a full human rights evaluation before entering the country. It's also deeply involved with several important industry initiatives, such as the Telecommunications Industry Dialogue, which helps impose standards upon Telenor in terms of protecting users' privacy rights. And then from a commercial forward-looking perspective, what we also like is we think that a lot of the lessons that Telenor is learning on the ground in Myanmar could help boost the company's positioning when it comes to future expansion to other challenging emerging markets, which telecom companies are increasingly looking to for growth opportunities. And we would flag sub-Saharan Africa in particular. So we think a lot of these lessons that the Telenor is learning will put the company in good stead going forward. Our eighth piece looked at Pemex and the opening of Mexico's energy market. We took a positive view in this piece and really argued that the increased participation of Western oil majors will ultimately, we think, transfer important health and safety benefits in terms of best practices, policies, so forth, and will also put pressure on Pemex to shore up its governance controls. So as most of you know, or some of you might know, the company has been hit hard in recent years with allegations of fraud and embezzlement and some irregularities in contracts with suppliers. And of course, corruption in state-owned oil companies is top of mind these days, with the announcement earlier on February 2nd, I believe, earlier this month, of Petrobras's CEO and a few directors stepping down due to related corruption scandals. So we think this will only increase the pressure on Pemex officials to clamp down on corruption. So the rationale for Mexico's move to open up its energy market is to boost the country's falling oil production. So as you can see here, production has really trailed off from about 4 million barrels per day in 2004 to under 3 in 2014, under 3 million barrels per day. So Mexico opted to liberalize its markets and loosen controls on Pemex, which has been a monopoly, or had been a monopoly for 77 years. So looking ahead, the first round of bidding by oil majors is expected in June, and already Exxon, Shell, BP, and others have expressed interest in submitting proposals. And again, in our story, it's obvious a rapid technological catch-up process will be needed for Pemex to stay competitive, but we also looked at, as I said, its track record in health and safety incidents and its corruption to global best practices, which we think will improve through, especially through a joint venture structures. In our ninth story, we looked at Coke's recent entry into the energy drinks and more recently the high-end milk market. So Coke, like many of its peers, is being pushed into what can be considered non-traditional markets due to the admittedly small but still growing number of regulators who are moving to impose taxes on soda and other high-sugar drinks in an effort to stem childhood obesity. So we were obviously very intrigued when it was announced Coke was entering the high-end milk market. It's in some ways a departure, clear departure from their main line of business, but it is consistent with their historic strategy of diversification. So the products are marketed under the brand of Fairlife. Some of you may have seen that it was launched last month in the U.S. Interestingly enough, the milk is about twice the price of regular milk, but offers more calcium and more protein. So it really is a higher-end product. Some have pointed to, quite rightly, have pointed to the steeply declining consumption of milk and cream in the U.S. as shown in the graph at the top of your screen. This is obviously a structural challenge, but in our piece we also look at a variety of ESG risks, which we think Coke has, historically little strategic awareness over these risks by simple virtue of the fact this is a new market. So these would include animal welfare issues such as access to pasture and the environmental impact of dairy farming. To the company's credit, the Fairlife site, for those of you who have been there, offers considerable disclosure on these sorts of issues, but our analysis suggests that actually the disclosures lack detail and are not really part of Coke's reporting or management structure. They're part of Fairlife's. On the energy drink side, we explore in the piece risks related to the growing health concerns of energy drinks. There's a variety of suits right now, legal cases before the U.S. courts based on health concerns about energy drinks and high caffeine drinks. And of course, perhaps more significantly, the FDA signaled back in 2012 that they might consider regulating energy drinks, although they subsequently backed down from that position. But all bets are off if they move in that direction again. So we do not think Coke, its exposure is non-trivial, even though it really only has a 17% stake, a minority stake in Monster Beverage Corp. So this would obviously dilute the impact of regulation on Coke itself. And in our 10th and final story, we looked at Netflix, a company which is once again one of the darlings of NASDAQ after surprising last month with its Q4 earnings announcement and 17% bounce in the company's stock. With this piece, we focused, it's unique relative to the other 10 stories, the other 9 stories, in that we focused exclusively on corporate governance issues. We took a negative view on the company, pointing in large part to the series of majority approved shareholder proposals dating back to 2012 that Netflix has really not offered a meaningful response to. So for those of you who have followed the story, you'll know that these include proposals to include shareholder approval of poison pills, repealing the classified board, and establishing the right of shareholders to call a special meeting. So what we do in the story is we frame this, what we express as shareholder discontent in terms of a decision that shareholders will face in 2015 if a takeover offer emerges. So their will be tested in terms of whether or not they should reward management with a takeover offer. And we think, I mean, obviously the historic volatility in the company's share price, which you can see in the graph at the top of your screen, only encourages the possibility of acquisition. So with that, that concludes a brief summary of the 10 stories that we discussed in the report. And with that, I'd like to turn it back to Niamh.
Great. Thank you very much, Doug, and thank you, Doug and Hendrik, for such a thorough overview of the report. To lead the Q&A session now, I've just received some questions on the macro session to begin with, and I'd like to ask you, Hendrik, related to these questions, why have you taken such a sceptical view of the European Central Bank's quantitative easing program? What was your thinking behind that approach?
Yaniv, many thanks to the audience. Many thanks for this particular question. I know that there are views on this topic diverge significantly. So let me start my answer by quoting famous Ben Bernanke, the former chairman of the US Federal Reserve. He once responded to skeptical questions about the Fed's QE program by saying, "It may not work in theory, but it works in practice." Obviously, he was referring to the positive development of the US economy. So the question is, if it worked in the US, and by the way also in the UK, why should it not work in Europe? We do indeed believe that the seemingly positive empirical evidence for the US cannot be applied to Europe, or to be more precise, to the Eurozone. We have two or maybe even three reasons for this. Firstly, we found no examples in economic history for comparable programs that have worked against the background of structural weaknesses, forming the real underlying core of the problem. Japan may serve as an example. Secondly, the transmission mechanisms for monetary policy in Europe differ from the ones in the US. In the US, private consumption is a lead driver of growth, and it is, to a much more significant extent than in Europe, driven by the availability and cost of credit. And thirdly, and probably most importantly, Europe has a single currency zone, obviously, but what it does not have is a fiscal union. As you all know, the fiscal and overall economic conditions diverge significantly within the Eurozone, which is accordingly reflected in the very different national interests of its member states. The recent tensions around dealing with the situation in Greece bear testimony of this principal systemic weakness. Hence, all in all, we do not share the view that Ben Bernanke's optimism about the effectiveness of QE programs is applicable to Europe as well.
Okay, great. Thank you very much, Hendrik. I might just move to the micro section for a moment. And Doug, we are receiving some questions about the methodology that we have applied in the report. I was wondering if you could clarify for participants what sort of methodological approach we have taken to this report, whether it differs from Sustainalytics' regular approach to their analysis, whether any other research has been applied here, and how it has led to these robust findings in the report.
Sure, happy to provide some insight on that. So really, I guess there's two things. There's the methodology we use to arrive at the 10 stories, and then the methodology to conduct the analysis. So in order to get to the 10 stories, what we did is working with our research team, we screened our universe of companies for three things. First, we looked for instances where there was a clear connection between ESG performance and financial performance. And then second, candidate companies or stories, they really had to have a forward-looking component. So some sort of catalyst in 2015 that we're expecting to trigger the potential financial impacts. And then thirdly, we were looking for, as I said during the presentation, generally high-profile stories. So, you know, top-of-mind business events that mainstream media and portfolio managers would be interested in. So using this screening process, we arrived at a short list of companies and stories, and then we just simply selected 10 to cover off geography and industry in terms of diversity. As for the stories themselves, I would say the analysis is not dissimilar to our standard research methodology, but it's obviously less comprehensive. So in each case, one of the source documents we used in crafting the story was the Sustainalytics research profile for each company, but again, it's obviously much less comprehensive in the sense we were looking at, you know, one-off themes instead of a full suite of E, S, and G indicators. And then just to close out my answer, I'd say, generally speaking, though, there was agreement between the impact, the directional impact of our pieces, of our stories, and our analyst view on the company. So Intel, just as one example, is the top-rated company in our semiconductor industry, and we also had a favorable view in this piece. Perhaps the one notable disconnect was Lonmin. So it's actually our third highest rating mining company, but as I just described, our slant in the story was negative. I think this can be largely explained from a temporal perspective. We're looking at a short-term phenomenon, the exposure to the Marikana Commission in March, but certainly this does not disprove any of the good work the company is doing in other areas. And just quickly, in terms of research, we also relied on, in addition to the Sustainalytics internal piece profiles, we also relied on external research.
Okay, great, Doug. And I've received some follow-up questions here with regard to individual companies and changes in personnel, for example, in GlaxoSmithKline in recent months. And just going forward over the year, how would you advise investors and readers to take these changes in companies into consideration when they're reading our report now? How should they maybe marry both views going forward?
I think the focal point, the key point will be to engage through their relationship manager and maintain dialogue with our industry analysts, because our industry analysts are obviously covering these companies in real time. So I think they'll be able to best marry those views.
Okay, that's great. So would you advise them to contact individual analysts perhaps that are listed in the 10 for 2015 report?
Yes, I would. Yeah, I would. I'm also happy to be a point of contact, but in terms of getting real-time information on the companies, I think the best initial source would be the analyst team.
That's great. Thank you, Doug. And in terms of another clarification, we've been asked to clarify what we mean by impact when we refer to positive and negative impact of these companies. Can you maybe expand on that a little bit for participants, please?
Sure. This is our attempt to really hone in on the expected directional effect of the event analyzed. So it could be argued it's somewhat reductionist in the sense that we have two options, but it really is a directional impact. Sorry, it captures the directional effect of the event analyzed on the company's financial performance. So we recognize it really is challenging to forecast, even in scenario-based analysis, the financial implications of some of these issues. And in some cases, we're obviously still waiting on disclosure from management to provide a more holistic opinion. But generally speaking, yes, it refers to the directional impact of the event analyzed on the company's financial performance.
Okay, that's great. Thank you very much, Doug. Perhaps one other question with regard to some of the positive companies. Are some of our stories a little bit too good to be true, do you think? Being a devil's advocate for the moment?
No. No, I think in each and every case, we employed sober judgment analysis and kind of drew the piece where the data and our research took us. Perhaps in some cases, I mean, if looking at Intel, for example, I mean, we acknowledge we took a positive spin on this piece. As I said in my brief presentation, we're very bullish on the company's efforts in this regard, but we did our best to offer a mitigating opinion as well. So in that case, we recognize that actually executing this goal will be hugely challenging, and we say that in the story. And in fact, just thinking about Intel, I remember reading that the CEO himself puts their chances of success at something in the neighborhood of 50 to 75%. So in that regard, maybe we're slightly optimistic, but no, I think generally speaking, we try to be dispassionate and just take it, go where the data and research take us.
Okay, that's great. Thank you, Doug. Just following on that line of thought in terms of positive and negative scenarios and outcomes, I might turn back to Hendrik for a moment and the macro view. And Hendrik, we've got a question here related to your forecast for this ongoing scenario of the drop in oil prices, and you've mentioned some positive outcomes of that, but many negative, and one of them in particular related to the possible collapse of the COP21 discussions in Paris at the end of the year. Do you think that you're taking an overly, again, negative view with regard to this potential outcome?
Yes, thanks, Niamh, for this question, and I have to reiterate that we do not make explicit forecasts, but of course you are true. I mean, we have a clear opinion about that. So from our point of view, in this case, it is all about the economics of climate change, i.e. the discussion that had been dragged into the public sphere by Sir Nicholas Stern's famous report a couple of years ago. In a nutshell, two components enter the equation. On the one hand, the cost of climate change, i.e. of increasing temperatures. Obviously, these have not changed as a result of the oil price drop, but structurally suffer from the fact that in economic models they need to be discounted and shown as present values. They of course appear much smaller, reflecting the so-called intergenerational accounting problem. And on the other hand, and I'm talking about the second component of the overall equation now, are the cost of climate change mitigation, i.e. of avoiding the future costs of rising temperatures. Now with the oil price drop, the relative costs of climate mitigation have increased, obviously, i.e. those costs that are immediately felt by companies, by private households and governments. And it is precisely these costs that represent the main common force putting pressure on climate change negotiations to come to an agreement. So what we are saying here is that the strongly reduced oil price certainly does not make it easier for national governments that may even want to be re-elected to achieve a multilateral agreement in Paris that effectively tries to curb emissions in order to achieve the 2-degree target. However, I want to stress again that this would not imply the end of decarbonisation efforts. We do only expect a shift towards regional and private initiatives, with the latter being less relying on regulatory incentives.
Okay, that's great. Thank you very much, Hendrik. If participants had any follow-up questions with regard to the macro view, again, would they be able to contact you directly to address any further questions?
Sure.
Okay, that's great. Thank you very much. And that's an open invitation to all of you on the call today. If you didn't get a chance to send us in any questions, or if you have any follow-up questions, please feel free to contact us over the next few days, and we'll be more than happy to answer any of those questions for you. Just to reiterate, this webinar has been recorded as well and will be sent to you with the presentation slides over the next few days. I think now, as we're coming up to 5 p.m. CET, Central European Time, I would like to thank Hendrik and Doug for a very informative presentation today. I think it has led to a lot of nice, interesting questions and hopefully follow-up questions as well. And I would just like to thank all of you participants for listening into the webinar today, and please stay tuned for further webinars that we will be having in future about forthcoming sector reports and research that we're doing here in Sustainalytics. So again, thank you very much and goodbye.